There is a company that has been selling life insurance to working-class American families since 1979. It is not Prudential. It is not MetLife. It is a McKinney, Texas-based insurer that markets through union halls, door-to-door salespeople, and direct mail. And it just posted Q1 numbers that are going to get people's attention.
Globe Life, Inc. Ticker GL. Life and health insurance. Q1 2026 revenue of $1.57 billion beats the $1.56 billion estimate. EPS of $3.57 beats the $3.46 estimate by 3%. Management reaffirmed full-year guidance. The stock is near its 52-week high.
Today on Charged Alpha, we are going inside a company that almost nobody talks about, that has been quietly shrinking its share count, growing its investment portfolio income, and serving a demographic that every large insurer seems to ignore. But we're also going to talk about why this stock spent the better part of 2024 under a cloud, and whether that cloud is actually gone. Let us go. Section 2, Company Overview. Lana, set the stage. What does Globe Life actually do?
Globe Life provides life insurance, supplemental health insurance, and annuities to lower to middle income households across the United States. They operate through 4 segments: life insurance, supplemental health insurance, annuities, and investments, and they run 3 distinct distribution channels, which is really what makes this company interesting.
Walk us through those channels.
The first is American Income Life, which sells through union relationships and worksite environments. If you are a union member at a manufacturing plant or a trade association, there is a decent chance an American Income Life agent has knocked on your door. The second is Liberty National Life, which uses a traditional direct sales force going door-to-door in middle-market households across the South and Midwest. And the third is Globe Life Direct Response, which markets through mail, television, and digital. The company that sends you that postcard offering $50,000 of life insurance for $9 a month.
And where is the company headquartered?
McKinney, Texas, right outside Dallas. The company was founded in 1979 and was originally known as Torchmark Corporation. You might recognize that name. They rebranded to Globe Life in 2019. The business has been operating in this same working-class insurance niche for over 45 years.
And they are not trying to serve the same customer as Prudential or MetLife.
Not at all. The key insight about Globe Life's business model is that it serves a demographic that large institutional insurers systematically underserve. Households that cannot afford whole life premiums at a major carrier's rates, that do not have access to employer-sponsored group coverage, and that respond to direct marketing rather than advisor-based distribution. That is a large segment of the American population, and GL has spent decades building the distribution infrastructure to reach it efficiently. Section 3.0 Background.
Who is running this company?
Frank Svoboda, President and CEO since 2019. He joined Torchmark in 2005 in finance and investor relations, became CFO in 2012, and stepped into the CEO chair when the company rebranded. He is a CPA by training, very much a finance-first operator rather than an insurance underwriter who moved into management.
And what is his track record?
His signature contribution has been the capital return program. Under Svoboda, Globe Life has been systematically buying back stock at a pace that most investors underappreciate. The company retired approximately $881 million in shares during 2025 alone, reducing diluted share count from roughly 95 million 2 years ago to about 80 million by the end of last year. That is a 5 to 6% annual reduction in shares outstanding, which means EPS grows materially faster than revenue. On the controversial side, Svoboda navigated the company through the 2023 short seller allegations about American Income Life application practices, maintaining the operational narrative without major concessions. Whether that was disciplined crisis management or something else is still debated. Section 4. The numbers.
Lana, give us the numbers.
Let me start with valuation, because this is a different kind of company than what we usually cover. Globe Life is a financial services company and a life insurer, which means the standard valuation frame is different. Price to earnings is the relevant metric here, not price to sales or EV/EBITDA in the typical way. GL trades at 10.45 times trailing earnings, which is cheap. The S&P 500 trades at over 20 times. Even relative to insurance peers, GL is at a discount.
Why the discount?
Part of it is the short seller controversy, which we will get into. Part of it is the customer demographic. Working-class insured households have higher mortality risk than typical insurance customers. And part of it is that the insurance earnings model is genuinely opaque. When you hear that an insurer earned $3.57 per share in the quarter, you have to dig into the benefit ratio, the reserve assumptions, and the investment portfolio composition to understand whether that earnings figure is durable. The market pays less for opacity. The stock is at 150.08, 52-week high of 152.80, so we are almost at the top. 52-week low was 111.13, and that matters because this stock was driven down by a short seller report about alleged application fraud at American Income Life. The stock fell over 3% from its prior highs before recovering. Today, at nearly the 52-week high, the market is saying the controversy is resolved. We will examine that claim.
Let us talk about revenue and cash flow.
TTM revenue of just under $6 billion, $5.998 billion to be precise, growing 6.1% year over year. This is a slow, steady grower, not a high-velocity business. But operating cash flow TTM is $1.4 billion, and free cash flow of $1.25 billion gives you a free cash flow yield of over 10% on the market cap. That is the core value argument for GL. It is a cash machine that trades at a significant discount to intrinsic value.
And the balance sheet?
The most important thing to understand about Globe Life's balance sheet is that it looks unusual by non-insurance standards, because it is an insurer. Total assets of $30.8 billion, the vast majority of which is the investment portfolio. Globe Life holds approximately $20 billion in bonds and other investments, which generate net investment income of roughly $1 billion per year. That portfolio is the engine that funds claims, expenses, and ultimately the buyback program. On the debt side, total debt of $2.6 billion against cash of $145 million, net debt of $2.5 billion, net debt to EBITDA of 1.56 times, very manageable for the sector, stockholders' equity of nearly $6 billion, return on equity of 19.4%. Overall, Globe Life's financial health is solid. The company generates over $1.4 billion in annual operating cash flow, maintains conservative leverage at 1.56 times net debt to EBITDA, and delivers 19% return on equity through disciplined underwriting and aggressive capital return. The main watch items are benefit ratio trends in both the life and supplemental health books and the sustainability of the buyback pace as the balance sheet absorbs continued debt-funded repurchases. Section 5. What the Street Thinks.
What does the analyst community say about this one?
11 analysts covering GL. 8 buys, 3 holds, 0 sells. Consensus is buy. Average price target of $165, about 10% upside from current levels. Target range from a low of 148 to a high of 190. Wells Fargo has overweight, citing the buyback-driven EPS growth and rising net investment income. JP Morgan is overweight, viewing the short seller overhang as resolved and seeing value at 10 times earnings. Evercore ISI is the hold, cautious on benefit ratio trajectory and American Income Life channel sustainability.
And Q1 specifically?
Q1 was a solid beat after the Q4 stumble. Revenue of $1.57 billion beat the $1.564 estimate. EPS of $3.57 beat the $3.46 estimate by 3.2%. Management reaffirmed full-year guidance at $15.30 to $16 in EPS for 2026 and expects premium income growth of 5 to 6% for the full year, with net investment income also trending higher. After Q4 2025 came in below expectations, Q1 is the reset quarter, and the beat, while not spectacular, puts the bull thesis back on track. Section 6. The Bull and Bear Case.
Let me run the bull case on Globe Life. The single most compelling thing about the GL bull case is the buyback math. The company spent $881 million on share repurchases in 2025 alone, reducing diluted share count from 95 million to 80 million over 2 years. That is a roughly 5 to 6% annual reduction in shares outstanding. When you layer that on top of 5 to 6% revenue growth, you get EPS growing in the 12 to 15% range from a very modest valuation base. That is the formula that drives the forward estimates. EPS of 15.38 in 2026, 16.54 in 2027, 18.17 in 2028. The second tailwind is the investment portfolio. Globe Life holds $20 billion in bonds, and that portfolio rolls over continuously as older, lower-yielding bonds mature and are replaced with current market rate issuances. Each 10 basis points of improvement in the portfolio yield adds roughly $20 million to annual net investment income. In a higher-for-longer rate environment, this is a quiet compounding machine that shows up in earnings every quarter, largely independent of the underwriting result. And third, the supplemental health growth story. Medicare supplement and supplemental health lines are growing faster than life insurance, driven by demographics and the expanding coverage gap for working-class households. Health premiums typically carry higher underwriting margins. As health becomes a larger portion of GL's premium mix, that should improve the overall earnings quality.
Now the bear case. The first risk is the one that almost nobody wants to say out loud. Globe Life's core customer, working-class American households earning $30,000 to $60,000 a year, has above-average mortality risk. These are people in physically demanding jobs with less access to preventive care, higher rates of comorbidities, and real exposure to the socioeconomic pressures that drive mortality in the United States. Any sustained deterioration in mortality trends, obesity, drug use, economic stress, shows up immediately in GL's benefit ratio, which is the single most important underwriting metric this company reports. The second risk is the short seller controversy. The 2023 Fuzzy Panda research report alleged that American Income Life was processing insurance applications without full policyholder awareness, essentially that people were being signed up for policies they did not actively choose. GL pushed back aggressively and conducted an internal review, but the investigation was internal, not external. No independent regulator has publicly cleared the company, and no settlement has been announced. That is not the same as resolution. If regulatory attention returns, and regulators tend to move slowly on insurance matters, the stock could retest the lows. Third, interest rate risk cuts both ways. Rising rates have been a tailwind for the investment portfolio. If the Federal Reserve moves to cut rates materially, reinvestment yields on maturing bonds will fall. A 100 basis point rate cut cycle could subtract $200 to $250 million from annual net investment income over the subsequent reinvestment cycle. A meaningful earnings headwind for a company where investment income is roughly 40% of the revenue base. Section 7. Peer comparison.
How does GL stack up against its peers?
The most useful peer comps are MetLife, Prudential, Primerica, and Unum Group. MetLife trades at 12.1 times earnings, Prudential at 13.4 times, Primerica at 18.3, and Unum at 9.2. GL at 10.45 sits in the middle of that range, at a premium to Unum but a discount to MetLife and Prudential, and a meaningful discount to Primerica.
That is a wide range. What drives it?
Market positioning and growth profile. Primerica at 18 times is the closest comp to GL in terms of serving the working family market segment, but Primerica is term life only, has a simpler business model, and trades at a premium because of that perceived higher quality. MetLife and Prudential at 12 to 13 times are diversified global insurers where the discount reflects complexity and international exposure. Unum at 9 times is the cheapest of the group, primarily group disability, lower growth, and a segment under structural pressure as employers cut group benefits. GL's 10 times PE is arguably the most interesting position in the peer set, close enough to Primerica's market niche to deserve a similar multiple but still priced at a meaningful discount. Section 8. Options activity.
Options picture on GL?
Formal put/call data was not available for this episode. GL has a beta of 0.47, one of the lowest in financial services, which tells you it is a very low volatility stock in terms of how it moves relative to the market. Options premiums on GL are correspondingly modest. At the 52-week high, covered call writing becomes attractive for long-term holders looking to supplement the 0.76% cash dividend. Defensive investors may find cash-secured puts in the 140 to 145 range interesting for establishing a position below current levels.
A low beta insurance stock near multi-year highs tends to attract exactly that kind of conservative income overlay.
Exactly. GL is not an active options trading vehicle. The people who own this stock tend to be long-only insurance sector investors and value managers who are patient holders. The primary return mechanism here is EPS growth through buybacks and modest multiple re-rating as the controversy fades, not options premium generation. Section 9. Insider activity.
Any insider moves worth noting?
No open market purchases or sales have been recorded in the recent period. Management alignment at GL operates primarily through equity grants and performance-based compensation tied to operating metrics. The real insider signal here is the corporate buyback program itself. $881 million in 2025 represents management putting the company's capital to work at current prices, which is the strongest implicit signal of intrinsic value confidence available. When a company retires 5% of its own shares in a single year, that is the board and management saying the stock is cheap.
And that buyback authorization continues in 2026.
It does. Management has continued to execute repurchases in 2026 as well, and the remaining authorization is still substantial. Section 10. Risks and watch points.
What are the key things to watch going forward?
3 specific watch points. First, the benefit ratio in the life and supplemental health segments. GL discloses benefit ratio quarterly. If the life benefit ratio ticks above 75% or the health benefit ratio shows a sustained upward trend, that is the first indicator that underwriting discipline is slipping or that mortality trends are worsening. Second, American Income Life Channel growth. Premium growth at AIL has been the engine of the business. If that channel shows deceleration, or if a regulatory investigation surfaces, it will hit both the multiple and the earnings estimate. Third, net investment income. Watch for management commentary on the portfolio reinvestment yield versus the legacy yield. If reinvestment is happening at rates above the existing book yield, that is a structural tailwind. If rates fall and the spread narrows, that is a headwind.
And the forward catalyst?
Q2 earnings. The second quarter typically shows whether Q1 was a trend reversal or a one-quarter bounce. If GL can sustain the EPS beat cadence into Q2 with stable benefit ratios and continued premium growth, the stock has a credible path to the upper end of analyst targets. If benefit ratios deteriorate or premium growth decelerates, the market will question whether the 10 times earnings multiple is actually cheap. Section 11. The bottom line.
Let us land this one.
Globe Life is a disciplined, cash-generative life and health insurer trading at a meaningful discount to the broader market and many of its peers. The Q1 beat after Q4's miss is an important data point in the ongoing debate about whether GL's earnings quality is intact. The bull case rests on 3 durable elements: the buyback-driven EPS growth, the rising investment income from the $20 billion portfolio, and the deeply undervalued multiple. The risk is that the working-class customer base carries real mortality risk, that the American Income Life controversy is not as fully resolved as the stock price implies, and that interest rate declines could reverse the investment portfolio tailwind.
The central debate on GL is simple. Is 10 times earnings a value or a trap? The answer depends on 2 things: whether management is telling the truth about the quality of their insurance book, benefit ratios, application integrity, and mortality assumptions, and whether the buyback program, which has been the core of the earnings growth story, can continue at its current pace without introducing balance sheet risk. The next few quarters will tell you.
The key metrics to watch: benefit ratio in the life and health segments and net investment income per quarter. Those 2 numbers tell you more about Globe Life than any other financial disclosure the company makes. Watch them every quarter. Section 12, closing quote plus CTA.
We will leave you with CEO Frank Svoboda from the Q1 2026 earnings call. We delivered another solid quarter with premium income growth across both our life and health segments and continued strength in net investment income. Our direct-to-consumer and agent-based channels are performing well, and we remain committed to returning capital to shareholders through our share repurchase program. We are confident in our ability to grow earnings per share and generate long-term value.
Premium growth, investment income holding, buybacks continuing. That is a CEO reaffirming a capital return thesis in measured language. The debate is whether the underlying insurance book supports that confidence. Q2 will give us the next data point.
That is going to do it for this episode of Charged Alpha on Globe Life Inc., ticker GL. And hey, if you want to run the same research workflow we use to build these episodes, everything is free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I am Hudson Thomas. Section 13, Outrow Required Disclosure.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street